This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to our chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Oli's picture that says, Looking for the Downloads. Okay, let's jump into the chart deck. Eric, on page 2, we have that crude oil. Let's talk about the chart and also how did the EIA inventory data come in?
Well, Wednesday was a roller coaster day in crude oil markets, with WTI almost touching $78 to the upside early in the Asian session. But the market tanked in the European session to close the 75.60-something OPEC plus price gap on the WTI price chart before the U.S. market even opened on Wednesday morning. Then at 10:30, EIA inventory came in with a great big drawdown of 5.1 million barrels of crude oil. And that was really a 6.1 million barrel drawdown after you consider the million barrels that the Biden administration pilfered out of the SPR again this week. It's the fourth week in a row of drawdowns at a time when they told us they were going to be refilling the SPR at this time. So they're still drawing it down. Cushing, Oklahoma was the only build on the board, building 319,000 barrels. Gasoline drawing down 2.4 million barrels. Distillates drawing down 576,000 barrels. U.S. production ticked back down 100,000 barrels to 12.2 million barrels. Tape action, prices had dropped to fill the OPEC price gap before the data even came out. But then the market really beautifully rallied after inventory, seemingly responding to the bullish inventory draw and showing a convincing reversal after bottoming apparently right below the OPEC plus gap fill price just before the open. But that rally failed right at the crucial 100-day moving average, and then the market really tanked to trade below 74.30 by the close. Supports below the market are at 73.66 and 72.68, and if the latter doesn't hold, it could be new lows. There's really not a lot of support under the market below those levels. So it's going to be really interesting to see what happens next. It is still possible that this was just the shakeout stop clearing run going into Wednesday's close to shake the weak hands out of the market. The people who had just gone long on the gap fill, expecting that was going to be the bottom with short stops, maybe this was just to shake them out, and we're going to recover from here. But if this market can't get back above the 100-day moving average at about $77 in the next couple of days, then we're probably headed back down toward the lows in the low 70s, if not back into the 60s. So it's going to be really interesting to see what happens next.
Yeah, Eric, when I look at this chart, obviously we had a very big rally through March into the first few weeks of April, and it really came to the top end of the trade range. We now obviously had that full gap fill and retracement. We're about the 50% retracement of the entire rally, and more importantly, we're testing the support line where almost all of the lows were established all the way going back to October of last year, right up until the March breakdown. This is a really important support line, because if we find that oil finds support right in here and this becomes a buy zone and trades back to the top end of the range, then it will continue to support the idea that oil is already establishing a basing formation that may lead to bullish price action in the future. At this stage, will the support line hold is the thing to watch. Now let's move on to the equities. First off, Eric, what are you thinking here on the S&P 500?
I really don't have any strong conviction on equities this week. I don't think the bear market bottom is in yet, and when it does come, I think it's going to be at or below 3,000 on the S&P. Last week, I was leaning toward the market melting up to 4,300 before rolling over to the downside. Needless to say, this past week makes it look like it already rolled over and the bear market is already back on. But as of the time of recording, we were just above must-hold supports. So if this this is just a correction, it should end here. If the selling continues below this level, then my 4,300 projection will be thrown out the window and the downside target is 3,000 by year end or maybe early in 2024.
Yeah, Eric, that 4,300 is pretty important. I think it's a level that could still be arguably tested as we move forward. On page 3, though, we have the S&P 500 support resistance levels. Now, Nick, what are you watching and what are the options market telling you?
Spot right now is 4060 approximately on SPX. So we have a call wall above at 4,300 and a put wall below at 4,000, which is also very, very heavy support. The implied move for the May 19th OPEX, again, keep in mind that next week we have FOMC on Wednesday, which should be a volatility-inducing event, is 120 points in either direction. So from the current price of 40.60 or so, we have an upside expected move of 41.80 approximately. Keep in mind 4,200 is also heavy resistance. And on the downside, we have 39.40 as a lower expected move. Keep in mind, again, we have support at 40.50 and 4,000. Yesterday, for example, we tested at the 40.50 area numerous times in the last hour or so, kept bouncing. We broke below it temporarily and then boosted above it into close. So that level is held pretty strongly. Again, I mentioned last week that I think we're going to see more volatility pick up after the April OPEX. And already thus far this week, we've seen a larger range in the first 3 days of the week than we had in the previous 2-3 weeks or so. So going forward, again, I'm getting more bearish as we push forward, but that doesn't rule out the possibility of a push to the upside of like 4180, 4200 area perhaps. It really is in the hands of the Fed next week.
Yeah, I agree with you, Nick. When we look on page 4, I put that overhead resistance at 4,200 where we rejected, but this entire correction so far has only just come back to retest a 50-day moving average. It hasn't even done a 50% retracement yet of the prior rise. There is no evidence that the bulls have at least yet dropped the ball. At this moment, if the bulls hold the line, and particularly like you're saying with that important put wall down at 4,000. Arguably, if the bulls just can keep this north of 4,000 throughout a 1 week correction, that could result in a bullish impulse that could easily see the S&P retest those 4,200 highs and or head toward that level, Eric, that you were talking about near 4,300. But what I wanted to highlight here was on page 5, I put the S&P 500 equal weight index ETF. And what's interesting is while the S&P 500 like the NASDAQ has been generally demonstrating strength, it really has come on the back of just a few mega cap stocks that have been doing incredibly well. Once you look at all of the S&P 500 stocks equally weighted, the rally has over the last month been incredibly weak. The S&P 500 equal weight index hasn't even made back 50% of the losses that incurred through the February-March drop. And so it just really shows you how thin that market breadth is and how reliant this market is on the continuation of those real big leadership names.
Yeah, Patrick, as I mentioned last week, we have roughly 20 companies that have carried about 90% of the gains on the S&P over the past few months or so. And, as we saw yesterday, for example, Microsoft was up about 8% after a solid earning report. Google was pretty much flat after, I would say, a so-so earning report. Today we have Meta, which beat earnings last night. They're up about 10% or so. So you have a few names that are carrying the overall market because of the sheer size of them, right? You have these trillion-dollar companies like Microsoft, Amazon, Apple, for example, that are carrying the market higher. And you have the majority of companies that are kind of stagnating. So if a lot of people that are watching this show see that we have names in your portfolios that haven't moved at all or even slightly down, the reason being, you might be wondering, is that it's the Apples, the Amazons, the Metas that have been carrying the market higher.
Right. And, and that really is also been what has created that outperformance in the NASDAQ in general. So on page 6, we have the QQQs. And yeah, they've held up. I mean, they've corrected here in the last little bit, but overall continues to show relative strength. And we'll talk about it in a second, but let's start off just with the levels that you're watching.
The spot right now is 314 approximately. There's a call wall above at 330, a put wall below at 280. The implied move for the May OPEX, again, is $12 or so in either direction. So the upside expected move is around 326 with key resistance above at 320. And the lower expected move is 302 approximately with key support at 300. Now, keep in mind, we have Intel earnings and Amazon earnings today after the bell. And then next week we have AMD, Airbnb, and then most notably Qualcomm and Apple, especially next Thursday, May the 4th, after the FOMC event.
You know, Nick, what I wanted to talk about here on page 7, I put that Russell, and we haven't followed small caps too much on these talking charts, but it's just amazing to see how weak the small cap space has been. Now, in fairness, the small cap index does have a lot of regional banks in them, which have been the worst performing sector, obviously, because of the regional bank crisis, which has been a drag on this. But it does show that real issue with broad market breadth. There simply is not any significant strength in stocks outside of those big mega caps that you talked about. And it really is most evident on page 8, where I have the Russell over the NASDAQ. And it just goes to show that the Russell continues, it's almost at a fresh new low in terms of this factor analysis of just looking at the fact that the NASDAQ it has to pretty much continue to demonstrate this strength in order for the current markets to hold up, or we would have to see some catalyst emerge that would broaden the breadth of the market and cause a much stronger rally. Will the Fed next week be that catalyst? That's certainly the thing to watch.
That's a good point overall, Patrick. Like one thing I just thought about right there was that most of these small cap companies are not very well capitalized, and with higher interest rate environments, it makes a probability, or rather increase the probability of them failing much, much higher, and therefore makes them much, much riskier investments. So that could be a reason why we're seeing, a flight into safety, safer names of Microsofts, Apples, Googles that are well capitalized versus these small cap stocks.
All right, let's move on to page 9, where I have that volatility index. And what was surprising is we had that really sharp drop in volatility. And while the VIX was down to like the 17-16 handle on the downside, daily volatility implies were single digit at one point the other week, until this little market drop suddenly brought volatility back. Do you think that we're going to normalize back up near the 20 level, or do you think we can stay down here in the lower teens?
I think we're going to stay suppressed for a while, especially if the FOMC event is a nothing burger event. What I've noticed, though, the past few months, notwithstanding the Silicon Valley Bank collapse, is that what happens is that after the monthly OPEX each month, we tend to see a volatility spike temporarily, and then we regress back down into the following OPEX, right? So, for example, last week we were very, very muted. The week before we were very, very muted as well in terms of movement. This week already we've seen a lot of volatility, but that should regress as we approach the May 19th monthly OPEX as well. So I expect that we'll stay below 20, but again, anything can happen. There's rumors that another bank could fail, perhaps one of the small regional banks. And if that does happen, then, that could cause another leg down perhaps. And if we get below that 4,000 level on the SPX, then look out below.
All right, guys, let's move on to the US dollar index on page 10. What are you thinking here on the dollar, Eric?
The dollar's consolidation at the low end of the trading zone has steadied now, and it could last a while. A close over 105 or below 100 is needed before a new directional trend can be declared. So until that happens, we're officially holding steady and waiting for the next shoe to drop. More and more notables are predicting that the next shoe to drop could be a sharp move lower on the dollar. But despite that view's increasing popularity, it hasn't happened yet.
That dollar index does continue to hold along those previous lows at 101, but what really will decide this is all of the central bank news that we're going to be getting in the next week, starting with the Bank of Japan here, the ECB, and the FOMC all within a week. And really, I think that may determine whether or not the dollar has another leg lower or whether or not the trade range prevails. At this stage, even a very short-term break of the 101 level, long as it gets back into that trade range, we could see the dollar continue to bounce around in this 101 to 105 level. But let's see whether or not the central banks start moving this market or not.
Now, guys, on page 11 here, we have this chart of the gold futures. What are you guys thinking here?
Little change from last week. The market is stuck between round number support at 2,000 and overhead resistance between 2060 and 2080, the latter of which, of course, was the all-time high for gold. My prediction is that we will eventually get to new all-time highs before this bull market is over, but not right away. This is a pretty formidable resistance level. We've come a long way very quickly. It's time for the market to consolidate a little bit before it breaks through this level. So I'm watching for a close below 2,000 to start a rout. Looked like we started to have that. We had one close, I think, below 2,000, and then Wednesday was closing back above. And as I'm recording right now, I'm looking at 1998 on the June contract. So we're holding right around that 2,000 support level. My guess is that is going to fail. We're going to get a correction lower. How much lower, I don't know. But eventually, I do think that we'll break out to new all-time highs.
My view overall is that gold has been benefiting from that U.S. dollar weakness in general. And obviously, with all these central banks coming out, we're going to get a potential currency move. I think gold will, on first reaction, move inversely to what the dollar is doing. I still think technically this is a bull trend, and there's nothing stopping gold from taking another stab on the upside, maybe punching 2,100 on an advance. But overall, I think that the dollar will decide whether or not this breaks to all-time highs and sticks to it, or whether or not we mean revert back to 1900. Nonetheless, I wanted to just finally look at the copper chart on page 12. And even up to last week, when it was holding above $4 and making higher highs and higher lows, there was still some sort of flows that gave copper a chance to have some sort of a bull breakout. With the recent weakness and the breakdown below $4 down toward the March lows here, at minimum, we just really have a copper market that's inactive. It doesn't mean it's going to be outright bearish, but clearly no new bull cycle is underway yet, and we're certainly going to watch how long this consolidation and trade range prevails. I still think that it resolves itself bullishly, but we're just going to need to see a little bit more price action. Maybe it's going to be a second half of the year story.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.